I want to talk to you about balance transfer credit card, and there are some mistakes you need to avoid if you want to transfer some balances from one card to another. Okay, it's not just about the 0% APR or just the 18 months or the 21 months. So you need to really pay attention to. I want to go deeply into the errors that you need to avoid if you want to transfer balances properly and actually come out of it actually in a positive with a positive results. Okay, so here are the top errors I want you to really pay attention to. First of all, don't apply without checking if you qualify. I mean, you hear there's a 0% intro APR for 15 months or 18 months, and you really sort of like, I don't want you to go gung ho to jump on the opportunity because this may not be an opportunity for you. So you always want to check the conditions. Every time you submit a credit card application, the lender notifies the credit bureaus and adds a hard inquiry to your credit file, right? It doesn't matter if you are getting a balance transfer credit card application or just a regular credit card application. Every time you have this sort of hard pull, you are losing 10 points, 15 points, and you're losing it across the board. You're losing it with TransUnion, you're losing it with Equifax, and you are losing it with Experian. So you have this sort of damage, temporary damage to your credit score to account for. So, and the thing is that those hard inquiries, they stay on your credit report for 2 years, and they affect your credit score big time. They affect your credit score for at least 1 year. Think about it. This is a one-time transaction. This is a one-time hard pull that it stays on your record for 1 year. So this is like the if you're not sure that you can qualify for a balance transfer, don't actually apply because the risk versus rewards is actually there is an imbalance between risk and rewards. Okay, so this is an important element to think about. If you want to actually counter this sort of scenario, this gloomy scenario, you want to go for a pre-qualification. So pre-qualification means what? It means that you, instead of getting a hard pull, you are getting a soft pull. And a soft pull is always good because it gives you information about your potential, your ability to potentially qualify for a credit card without affecting your credit score that much. Okay. Another mistake you need to avoid when it comes to a credit card balance transfers is assuming that you can transfer all your debt to one card. And this is another big problem. Why? Because normally when you have a credit card balance transfer opportunity, you do have a set credit limit, right? Because a balance transfer credit card is like a regular credit card. So the credit card issuer is going to set a limit, maybe 10 grand or 15 grand or 20 grand or 25 grand or even higher, depending on your credit profile, depending on your financial situation, and depending on the relationship you have cultivated with the financial institution. Like, for example, if you have had a Bank of America checking account for many years, and they have, like, let's say, a balance transfer offer, a balance transfer opportunity, chances are Bank of America, as long as you have a good banking relationship with them, they will be tempted to give you a larger credit limit than if you were to choose a Truist or Wells Fargo or KeyBank or Navy Fed sort of a balance transfer credit card opportunity. Okay, so when transferring debt to a new balance transfer card, keep in mind that you may not receive a high enough credit limit to wipe it out completely. Your credit limit is determined using several factors actually. So besides the relationship that I just told you about, the relationship you have with the existing provider, you also have your credit score. So where you are at in terms of your FICO journey, that can have a big impact. Okay, I mean, logically, if you have a FICO score of 750 or 800, you're not getting the same limit as if you have a FICO score of 300 or 350. Okay, so besides credit score, you also have your household income, how much you're making actually on a monthly basis or annual basis, and the type of income you have. Do you have maybe a retirement income or, let's say, a full-time job or a part-time job, that kind of stuff? You also have to account for your existing debts, but also other payment obligations. one thing for sure, the lender is checking all these elements before approving you, and also establishing your initial credit limits. Another mistake you need to avoid when it comes to a balance transfer credit cards this year is to actually make a late payment on the new card. I mean, that's a big no-no. That's a biggie. You never want to have that. So one thing for sure, you actually seize an opportunity, right? You seize an opportunity. The lender trusted you, and so the fastest way to actually reduce your credit card potential, like your limit potential, but also your FICO score, but also to ruin your relationship with a new credit card provider, is actually miss a payment, miss a payment, or make a late payment. Okay. So when agreeing to a balance transfer card, you are also consenting to the issuer's terms and conditions. Okay. So after doing a balance transfer, one of the expectations is that you make your payments on time all the time. Okay. Because the consequences of just one late payment means your balance transfer card your balance transfer could become far more expensive instead of saving you money, because there are some fees that are triggered once you miss a payment. Okay, so even the best 0% intro APR cards will void the intro period if you make a late payment. So instead of 18 months that you actually sign up for, you are going to start paying high interest right away. And if you pay the balance transfer fee already, you likely won't get it back. Okay. Plus, you will probably see a late fee assessed to your statement. Okay. So those are things that are really there to make sure you never miss a payment. So to sour the problem even further, the issuer may also impose a punitive interest rate for a few months, which is even higher than the regular rates. So read the terms and conditions of the card to know what that rate will be and how it will be applied to your situation. Another mistake is running up debt on the old card. So after you transfer your debt to the new card, the original card will have an open credit limits, right? Meaning you can make charges. So while doing so can be temporarily helpful, especially if you are also winning, if you are earning rewards when you make those purchases, you should take plans to pay the bill in full every single month. Okay, this is actually good for your financial situation, your budget also. If you don't actually if you don't pay the bill in full every month, the debt can creep up, interest will be added, and you may find yourself in a worse financial position than when you started. Okay. So not only will you have a balance on the new credit card, but also on the first. So that can add stress to your budget as you try to make the payments. Additionally, the escalating debt can hurt your credit utilization ratio, causing your credit score to decline. So another mistake I want you to really think about is not having a payoff plan. So when you transfer balances, one thing for sure, you're not really transferring the debt away. You're just transferring the debt from one card to another, from one lender to another lender, right? So the debt is still there. Maybe you might like pay off a little bit, but the debt is still there. You're not actually, the debt hasn't disappeared. Maybe the interest rate has gone down. Okay, so if you don't have a payoff plan, you're not going to be able to cope with the new debts with a new provider in a responsible way, and that's really bad. Especially if you are speaking about a large amount. If you have a 5-digit debt like 10 grand, 25 grand, or 50 grand, this amount of debt require a strategic plan. Okay, so balance transfer cards can help you get out of debt quickly, but you need a payoff plan. So review your budget to determine how much you can dedicate to the debt payments on a monthly basis. Again, I'm speaking about you having an Excel spreadsheet, so you have a clear idea. There's no surprise. There shouldn't be no any surprise at all as to how much you can dedicate to payments. Okay, so once you do that, you can grab a calculator to determine how long it will take you to pay off the debt. Try using actually a credit card payoff calculator for help. If you need help, let me know in the comment section, and I should be able to help you figure out what's the best strategy for you. What you want to do is you want to arrange the payments so that you're out of debt before the 0%, the intro 0% APR period ends, right? So let me give you an example. Imagine you have a 5,800 balance on a new card that gives you a 0% intro APR for 15 to 18 months. To pay off completely, you need to pay a minimum of $387 every billing cycle. What you want to do is you want to set an automatic payment for that sum so you never miss a due date. And what I also say is that don't wait until the due date to actually make the payment. So if they say you have to make the payment on the 5th, you want to make the payment on the 4th or the 3rd. That way you cover if something were to happen. So without a payment plan or without a payoff plan, you may make payments that are too small to keep pace with a zero interest period, and that could leave you with a remaining balance and accumulating interest after the expiration date strikes. Another mistake I want you to really think about is actually neglecting the fee in your analysis. So every time you have a balance transfer or a credit card, you have a fee, right? The fee can be 3%, sometimes it can be 5%. Usually it's 3%. But nowadays you have some banks that are charging you 5%. So it's always between 3 and 5%. And banks are pretty smart. What they do is sometimes they tell you, it's 3%, but there is a minimum. And the minimum can be $5. The minimum can be $15, can be $25, depending on the bank. Okay, but those fees are important because the fee can go all the way to can actually be in hundreds of dollars. So if you are trying to save interest in the first place and you end up paying hundreds of dollars in fees, ask yourself if the transaction is economically interesting for you. Because believe it or not, almost all balance transfer credit cards charge a balance transfer fee, usually between 3 and 5%. So let me give you an example. On a balance of $8,000, for example, your balance transfer fee could be $240 to $400. That's a lot of cash. And see, the thing is that, and this transaction, this fees are actually one-time fees. So when you annualize them, you actually see a higher APR. That's the kind of calculation that most people don't make. They think is actually a 3 to 5% annually. No, because when you annualize 3 to 5%, you're getting like a 60%, for instance. So balance transfers can be a good idea if the fee is high, because you got to look at the APR you're trying to save. Because going from an APR of let's say 15% to 0%, if you have a high balance, this could be pretty worthwhile economically speaking. Next, using the card while you're paying off the transferred balance is also a pretty bad idea. So for balance transfer credit cards, the 0% intro APR applies to the debt you move over. And in many cases, you will be charged the standard APR for purchases unless the card offers an introductory APR on purchases as well, and an even higher cash balance, cash advanced APR if you take a withdrawal on the card. So if you assume you can enjoy the zero interest period on everything, think again, okay? As long as you have enough available credit, you can make purchases with your balance transfer card. Beware, however, because using the new card while you are in repayment mode can complicate the process. So with a carefully developed payoff plan, you will have a debt payoff date to strive for. But having said that, if you make more purchases, you'll have to compute payments for those transactions too. Another mistake I want you to think about, and again, I'm still talking to you about the balance transfer credit card mistakes to avoid, and adding loan debt without thinking it through. See, the thing is that the whole idea here is what? The whole idea here is to reduce your credit utilization ratio, your CUR. The whole idea is to reduce your DTI, debt to income ratio, right? So when you move balances from here to here, from one card to another, from one provider to another provider, you're essentially trying to not only save on APR on interest, but you're also trying to reduce your credit utilization ratio, because your credit utilization ratio, simply because your transfer balance is not going to go down, but what will go down is once you have enough money, because you're paying less interest, you have enough money in your budget to actually dedicate toward the principal of the loan or the debt. Okay, so this is really important to remember. But adding loan debt without thinking it through can be detrimental for you, because personal loans can have a very high interest rates. So you may be tempted to move other debts to a balance transfer credit card instead. So unlike credit cards, however, installment loans are not included in your credit utilization ratio. So basically, they actually they are their own separate factor, right? So installment loans go for the DTI, the debt to income ratio. So converting loans into revolving balances can increase your credit utilization ratio and possibly result in a lower credit score. And also, and this is an important element I want you to pay attention to, the amount you have to pay to get out of debt every month may rise dramatically. Okay. So as long as you can handle a higher payment, the arrangement may be beneficial for you. But if you can't, you may put yourself in a tight spot that could be very difficult to actually get out from. Another mistake that I see a lot of people do when it comes to transferring credit card balances is actually not shopping around for for the best balance transfer card offer. Right? You got to really take your time. Don't actually rush to the first offer, the first opportunity you have, thinking this is the best. No, no. The good thing is nowadays you have financial platforms, financial websites such as Bankrate or other, I mean, Nerd Wallet, Bankrate or Net Wallet, that allow you to actually look for credit cards and actually search for credit cards on a soft pull basis. You can look for multiple credit card offers. Okay, so don't actually jump at the first balance transfer card that you see that you qualify for. You want to take your time. You want to pause and you want to weigh your options to find the best offer for you, because the best balance transfer cards offer long introductory periods, usually between 18 and 21 months. So other solid balance transfer cards have periods of 15 to 18 months, but sometimes they come with rewards to add long-term value. Okay, so you want to take your time, breathe a little bit, shop around to find the best offer for you, whether that means finding the longest intro APR period possible, or finding a card that will be useful to you after the period ends. Okay, so that's really important. And the last mistake I want you to avoid here is to don't miss the balance transfer deadline. Okay, so like I said, the deadline can be 12 months, can be 15 months, can be 18 months. It really depends. So many balance transfer cards place a limit on how long you have to transfer your balance, and some even have introductory balance transfer fee windows. For example, a card may require that you transfer your balance within 4 months of opening the account. Make sure you read the fine prints of the offer and transfer your balance within the time limit to remain eligible for the offer. And furthermore, some cards have a short window for an introductory balance transfer fee, which can be lower than typical fees, around 3%. So if you can't transfer your balance before the deadline, you can reduce the total amount you have to actually pay off your debt. So this is really good from a flexibility point of view. As an epilogue into this conversation, I spoke to you about the top 10 balance transfer credit card mistakes to avoid. Gave you a little bit about the top errors and now the epilogue. Thank you so much. God bless you. I will see you next time. Until then, remember, stay marvelous.